Welcome to Real Estate School. We're here to help you get past that real estate licensing exam. Today's topic, mortgage financing questions you'll most likely see on your licensing exam. So let's get started. So our first question will be, when homebuyer Dana pledges her newly purchased home as collateral for a mortgage loan, the evidence of the pledge is the A. Trust deed or mortgage, B. Promissory note, C. Loan commitment, or D. Loan receipt. And the answer is A. Trust deed or mortgage. The mortgage or trust deed, also known as a deed of trust, is evidence of the collateral pledge for the purchased property as security for the loan. Our second mortgage finance question that you'll most likely see on your real estate exam. A mortgage company charges borrowers a 1.5% loan origination fee. What will the mortgage company charge as a fee if the asking price of the house was $235,000, the sales price is $210,000, and the buyer is making a down payment of $50,000? And your answers are A. $2,400, B. $3,150, C. $3,525, and D. $3,750. We have to recognize in this question that the sales price, the asking price of the house, $235,000, does not factor in. The sales price is $210,000. This is the purchase price. However, the buyer is making a down payment of $50,000, and points are based on the amount financed, not the purchase price. So we will have to take the purchase price of $210,000, subtract the down payment of $50,000 to determine that the buyer is going to be financing $160,000. And $160,000 times 0.015, which represents 1.5%, and the answer is A, $2,400. Question number 3. A deed of trust involves all these terms except A, lender, B, borrower, C, trustee, D, mortgagor. Well, the question says except. A deed of trust involves all these terms except. The term that is not involved with a deed of trust is D, mortgagor. A mortgagor is the borrower in a mortgage. In a deed of trust, the borrower is the trustor, and the trustee holds legal title in trust for the beneficiary, the lender. Good point to remember for your exam. With the deed of trust, the home buyer is the trustor, not the mortgagor. Okay, let's move on to our next question. One afternoon, a client calls a real estate broker. My lender just told me that my note and mortgage is a negotiable instrument, says the client. What does that mean? Which of these would be the broker's best response? A. That's great. It means the lender is willing to negotiate on the interest rate. B. Oh no. That means the mortgage can't be assumed by the next person you sell it to. C. Don't worry. That means the mortgage can be sold by the lender, but you're not affected. Or D, uh-oh, that means we have to go back to the sellers and ask them to pay the points. Well, your answer is C. Don't worry. That means the mortgage can be sold by the lender, but you're not affected. Negotiable instruments are transferable. A note and a mortgage will often be sold on the secondary market. In the sales process, though, the terms of the mortgage usually won't be changed or can't be changed, such as interest rate and monthly payment. Moving on to our next question, question number 5. A mortgage document contains the clause, "In the event of borrower's default under the terms of this agreement, lender may declare the entire unpaid balance of the debt due and payable immediately." This is called A hypothecation clause, B, an acceleration clause, C, a defeasance clause, or D, a release clause. The answer is B, an acceleration clause. An acceleration clause can be used to make the remaining balance of the loan due if the borrower defaults. Hypothecation is the act of offering the property as security without giving up possession. The defeasance clause in a mortgage defeats the granting clause. A release indicates that the loan has been paid in full. But again, our answer here is an acceleration clause. The first step in foreclosure for the lender is to accelerate the maturity of the debt. Instead of having 262 payments due, they're all due today. Without an acceleration clause, the lender would have to sue the borrower every time a payment was overdue. Mortgage questions that you will see on your real estate licensing exam. Question number 6. For a loan that is not backed by the Federal Housing Administration, FHA, or the Veterans Administration, VA, and for which the borrower is making a down payment of less than 20%, the lender is likely to require the borrower to obtain A, subordination agreement, B, private mortgage insurance, C, a letter of credit, or D, a cosigner on the note. And your answer is B, private mortgage insurance. Mortgage insurance protects the lender against loss of a portion of the loan, typically 20 to 25% in case of the borrower default. Private mortgage insurance generally applies to loans that are not backed by the Federal Housing Administration, FHA, or the Veterans Administration, VA, and that have a down payment of less than 20% of the property value. The FHA has its own insurance requirement for loans with a down payment of less than 20%. We use the term government loans. That's what we refer to FHA and VA as, government loans. But understand, the government does not make the loan. In all cases, the government is insuring the loan. The lender is making the loan. The government is insuring the loan against to the bank against lender default. Well, without the government involved, your insurance comes from a private company. If you've ever wondered what the difference is between PMI and MIP, there you go. Question number 7. A homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for the loan. The homeowner retains title to the property. This is an example of A, intermediation, B, forfeiture, C, hypothecation, or D, subordination. And your answer is C, hypothecation. The process of securing a loan by pledging a property without giving up ownership of the property is called hypothecation. Pledging property as security for the loan. Question number 8. In a deed of trust transaction, which of the following occurs? A. The beneficiary conveys title to a trustee in exchange for loan funds. B. The trustee conveys title to a beneficiary in exchange for loan funds. C. The trustor conveys title to a trustee in exchange for loan funds from the beneficiary. D. The trustee conveys title to a trustor in exchange for loan funds from the beneficiary. Understand, in a deed of trust, as in most all trusts, there's three parties involved: trustor, trustee, and beneficiary. With a deed of trust, the beneficiary is the lender. The trustee is the attorney who holds ownership of the property in trust on behalf of the trustor, the home buyer. So in this question, C would be our answer. The trustor conveys title to a trustee in exchange for loan funds from the beneficiary. A deed of trust conveys title to the property in question from the borrower, the trustor, to a trustee as security for the loan. The trustee is a third-party fiduciary to the trust. While the loan is in place, the trustee holds the title on behalf of the lender, who is the beneficiary of the trust. Our next question. A lender lends money to a homeowner and takes legal title to the property as collateral during the payoff period. They are in A. Title theory state. B. Lien theory state. C. States allowing land trust. Or D. States where hypothecation is illegal. Looking at our question, a lender lends money to a homeowner and takes legal title to the property. At closing, the homeowner gives up ownership of their home to the lender. We're describing a deed of trust. States that use deed of trust are called title theory states. Title theory states are non-judicial foreclosure states. For a bank to foreclose on this property, they do not have to go to court. Title theory states do not require foreclosure, where lien theory states, states that use mortgages, do require court action to foreclose. Mortgage financing questions you are most likely to see on your real estate licensing exam. Question number 10. The three overriding consideration of a lender's mortgage loan decision are A. Points, interest rate, and loan term. B. The location of the mortgage property, the borrower's cash, and the amount of the borrower's equity. C. The ability to repay, the value of the collateral, and the profitability of the loan. And D. The amount of the loan, the borrower's income, and the down payment. And our answer is going to be C. The ability to repay, the value of the collateral, and the profitability of the loan. A lender assesses risk by examining or qualifying both borrower and property. In qualifying a borrower, an underwriter weighs the ability of the borrower to repay the loan. In qualifying a property, an underwriter assesses the ability of the property value to cover potential losses. In this evaluation, a lender requires that the appraised value of the property be more than adequate to cover the contemplated loan and cost. Finally, the loan must make money for the lending organization as a basic business precept. Mortgage financing Question number 11. How does the secondary mortgage market aid borrowers seeking a mortgage loan? A. It cycles funds back to primary lenders so they can make more loans. B. It issues second mortgages and sells them in the home equity market. C. It lends funds to banks so they can make more loans. Or D. It pays off defaulted loans made by primary mortgage lenders. Our answer is going to be A. It cycles funds back to primary lenders so they can make more loans. Secondary mortgage market organizations buy pools of mortgages from primary lenders and sell securities backed by these pooled mortgages to investors. By purchasing loans from primary lenders, the secondary market returns funds to the primary lenders, thereby enabling the primary lender to originate more loans. It also reduces the lender's risk, the ability to sell that mortgage. It would be a shame to have all your money lent out at 2.5% when the interest rate goes back to 6%. You'd like to have your money back so you can lend it out at a higher rate of interest. Important mortgage financing questions for your real estate exam. Our last question, number 12. What is the role of the Veterans Administration in the mortgage lending market? A. It guarantees loans made by approved lenders. B. It insures loans made by approved lenders. C. It purchases loans made by approved lenders. Or D. It originates loans made by approved lenders. And our answer is going to be A. It guarantees loans made by approved lenders. The Veterans Administration, or VA, offers loan guarantees to qualified veterans. The VA partially guarantees permanent long-term loans originated by VA-approved lenders on properties that meet VA standards. The VA's guarantees enables lenders to issue loans with higher loan-to-value ratios than would otherwise be possible. Thank you for tuning in and watching our video on mortgage financing questions you'll most likely see on your licensing exam. Please like, subscribe, and hit that bell below so we can notify you of all of our upcoming videos. In addition, in the comment section, let us know about anything you'd like us to cover in our next topic. Thank you very much.